Okay, Adem. Great to have you with us. Haven't talked in about 3, 4 months. You moved from Arizona to the coast. Has it given you any kind of different outlook on markets? And always interested in your views and what you're reading. What's going to be the big story in 2024,
You
according
know,
to Radical Adem?
I wish we had spoken uh, a week ago or 2 weeks ago because I had just wrote a thing on how regional banking issues aren't done and how
Okay.
commercial real estate is exposed
Yeah.
directly to the smaller and medium banks. And man, after New York Citibank community, and I heard you earlier in the conversation, you were talking like how they absorbed, New York Signature Bank after they failed last year. They took like 40 billion of their assets.
Yeah. That's
They,
VB. Yeah.
yeah, they're that bank that just what is it down like? So I'm trying to move my thing down. It must be down 70% still, 60, 70%. Yeah. Yeah, this bank is it, you know, I just don't see how banks can get out of further fragility. Like you have commercial real estate prices falling. Subprime auto loan defaults are at a what 20 plus year high. Subprime is always the first piece of the Jenga to go, right? You yank out the bottom pieces and it can
Yeah.
potentially bring down the whole thing. Yeah. Credit card delinquencies are on the rise. uh, the rate of change in meaning the year over year change, which I always think is important because people will say, oh, well, collectively, uh, you know, uh, the stock, the total stock of banks lending and credit card revolving credit, let's see, consumer credit, uh, is what matters. But I think it's the flow, the rate of change. And I like to tell it to people in this way. Imagine if you have a bank account and you have $100,000. That's the stock, the total amount. It's the income and the outflows. So the inflows and the outflows going into that bank account, that's going to drive the future stock, right? So if you're taking more out, that stock will eventually go down. And that's why I think looking at things in year over year terms shows the flow. So yeah, banks or credit demand is deteriorating as you can, if you could see that here. I mean, it had a big pop in December, and now it had a huge miss. It came in at just 1.5 billion, and it's all revolving credit. So credit's tightening. Bank loans and leases from banks are sinking like a stone. They're what, barely 1%, 1.5, 2% year over year at this point. That's way below pre-pandemic levels. And yes, we could say, it's reverting from a high point in 2022, but that's what, I think that's important when you're trying to measure in inflation and why I've been saying there's going to be more deflation than inflation. You have China slowing. China's exporting that deflation
Yeah.
abroad.
Copper
They
is
can't.
supporting your case.
Yeah, no, I mean, everyone said oil was gonna, with everything with the oil cuts, oil was dying, and then it had a little bit of a resurgence in October, September, October. It had a pretty nice pop up to the 90s. Since then, it's faded. I mean, all of OPEC, Angola left OPEC because they were getting so annoyed at Saudi Arabia. I mean, OPEC is essentially a cartel run by a country. Saudi Arabia shows up. For anyone who doesn't know, they'll be like, hey, these are the quotas your country's allowed to produce. Most of the time, the countries cheat. Like, look at Iran. They're not under quotas technically, but their production's up 20 plus percent year over year. Russia is producing more. They can't even get it out of the ports now, though. And then you had even and then Saudi Arabia just fell into a recession. They just had a negative 3.5% or 3.9% Q4 GDP. One
Is
before
that
that,
why they
Q3
want to
was
go? Is that why they want to go public
with
with
Aramco.
Saudi? Yeah.
Yeah, I think that, I mean, because this is what I try to when I was talking to people like a year ago, and they were like, "Oh, like Saudi out and OPEC output cuts, that's going to boost prices of oil to 200." And I'm like, "Listen, a cartel only works if everybody plays ball. Saudi Arabia's and OPEC's market share of oil, this isn't the 1960s and 70s anymore. Like when they controlled around like 60+% of the oil market, they barely control 30 now. So when they're cutting, what happens? Prices go up. You see US frackers start record
Yeah.
production. You see Guyana, you see Brazil. So they're soaking in those higher margins, right? Like by Saudi Arabia cutting oil, it's boosting prices that others are coming in and producing. And that's what we saw with Saudi Arabia. It didn't matter. It nullified their cuts. And now they're paying for it because there's such an oil-driven economy that by them trying to scale back those oil cuts, it slowed economic activity. And yes, now I think they need to do it because they're just bleeding money because they're trying to stimulate on the government side. So they need to get income from somewhere. If they can't get the price of oil to stay higher and they can't get the volume to go higher, I mean, then they're getting their lunch taken. And I really wouldn't be surprised if like what happened in 2015, 16, you see oil, Saudi Arabia try to flush out the competition,
Yeah,
specifically US
because the
frackers, more
frackers,
marginal.
yeah. Yeah.
Yeah, I would not be surprised. Like people are saying oil prices probably going to go higher. I've been saying I think it's going to go lower. Like if Russia and Saudi Arabia really want to try to, I mean, Russia's in the middle of a war. They're trying, and then China's slowing. They're trying to vie for market share. Where are they going to get it? And I mean, India has been kind of the place recently. And I don't know if you saw this about a month
So are
ago.
you
Saudi
like
Arabia,
a bear looking for 60 or $40 crude in the next 12 months?
I have no idea where it'll go, but I think it'll be
Okay.
lower. I think it will be lower if the Saudis actually do try to flush out oil with the record production and China weakness continues, specifically if some kind of weakness in the US continues. Granted, the US isn't like a huge oil consumer, rate of change wise. It's not like growing in the US like it is in China. I think if there is further slowdown, I wouldn't be surprised if we see it drop back down below 30 temporarily. Because
Okay, I'd
the
like,
lower it goes, the other countries will have to produce more.
okay. So what I want to talk about, and God, everything's reversed from that. I want to bring up WTI because, I'm bearish too, but if we get through 78, technically it won't look bad, but I have this level of Adem that I've had this line for forever off the prior two low 60s. But over 80 is going to look pretty good. It may
It could.
interrupt. And to back up technically what you're saying in um, when you're what you're saying about the regionals is the weekly on the KRE.
Oh,
It's
it's just
trying to hold here. So if you look left, we went to 52. I want to know if you think that this, because everyone's just poo-pooing, oh, it's just regionals. What would turn this into something systemic? Because the money centers look better than the regionals, but could there be a contagion
there could
where money
absolutely be
centers?
a contagion.
Okay, and why don't you give us a scenario
Uh,
how that could spread from
Oh,
regionals to money centers?
I don't know if anyone's looked at let me see if I got it.
Citibank or
I
B of
was gonna
A
say I think I mean B of A is sitting on an enormous amount of unrealized losses. All the banks are. It's about 700 billion.
as
Um,
Wells.
Bank of yeah, Wells. The the issue with the regional banks, I don't know if I'm sure you've seen in the news, German banks, Japanese banks now are getting killed because of the US commercial problems over the last week. Like it's already spreading abroad. They're huge investors in these products. They have no yield in those countries. So they've been buying these products, buying these banks. Banks now, the worst part, and like you were saying, contagion, because of the duration risk. That's, long story short for anyone who's interested, banks were pumped full of stimulus in 2020, right? Stimulus is
Yeah.
like a direct check. The thing is, when the government puts money in someone's bank account, it boosts the liabilities, right? Because that's money that can be taken out, right? You put in that whatever, $10,000 in a PPP loan, etc. That individual can go to that bank and take that money out. That's hot money. That's flighty money. So they can just come take it out. The banks had to match it with an asset. Loan growth was weak. So their loan book wasn't growing. So the banks were like, all right, let's buy treasuries, let's buy mortgage-backed securities, commercial real estate backed bonds, and securitized commercial loans, auto loans, auto-backed security, et cetera, et cetera, et cetera. The
You
acronym
see my
soup.
point about the XLF?
Yeah, I
Certain
do see.
ones look like the weekly in City doesn't look so great, and B of A looks even worse. I mean, this
Yeah,
is a big
B
rally.
of A has, I think B of A has the most unrealized losses of those bigger banks, of the big
Okay.
six. They're sitting on a big chunk. I mean, remember Schwab last quarter also
Yeah,
posted
Schwab.
really bad earnings. Ally Bank is the biggest subprime or auto lender in the US. You have the Bank of Ozarks. That's a huge bank now that's exposed to commercial real estate. And I don't think it's going to be as big as 2008 in this sense, but this is the difference. In 2008, everything was stamped AAA. So banks literally did not know what they owned, right? Like even if it
Yeah.
said AAA, you were like, I don't know if this is AAA. So everything froze up. It was like a confidence failed. Now, because of the duration risk, like I was saying for before, so the regionals, they were all pumped full of money. Then the government forgave a lot of the PPP loans. They didn't pull it out of the system. So the banks were like, all right, well, there's a ton of liabilities now to match with assets. So they buy treasuries, buy mortgage-backed securities. Then the Fed comes in and they hike interest rates. So all those duration risk just went through the roof. I mean, just down the drain, technically, I'm sorry, because the bonds have severe unrealized losses now. When SVB collapsed, all it takes is one depositor, like, hey, I want my money out. And those banks were
Yeah.
forced to go on the market, sell those assets on a fire sale to raise the cash. And obviously, once that happens and someone notices, I think their first bucket they tried to sell of assets, they sold it at an 18% discount. Obviously,
Yeah,
if you
to
bank
to,
with
to
SV,
Jamie Dimon,
yeah, to Jamie Dimon. And obviously, if you
right?
bank with SVB, you're going to see that and be like, what the hell? You just sold at a 20% loss? I want to get my money out, right? And then that's what happens. And then what's even worse is you go to the Fed or you use the discount window. And the Fed is trying to change the stigma. They actually are trying to pass a rule now that's telling banks they have to use the Fed discount window. For anyone who doesn't know, that's essentially where a bank can show up
Yeah.
with their bonds and be like, hey, I need cash at a good value. Otherwise, they're stuck selling it on the market for whatever price they can get. And but the thing is, when a bank does that, it tells other banks, like, huh, like, why are they
Yeah.
using the Fed? It's like needing mom and dad to bail you out, right? It just doesn't look good. So so then other banks stop, using you or they
Have you
won't
ever
lend to
tried
you.
it?
Oh yeah. Oh, having mom and dad bail me out? Oh yeah. It's
Yeah.
embarrassing. And there's a stigma about it in the US. And the thing is, it's funny because the Fed thinks they're trying to
You're a
break the
character, man.
stigma, right?
Yeah.
I mean,
Yeah.
it's really what's happening. It's like you can't get your friends. Normally a bank, interbank lending, they'll be like, hey, short on reserves at the end of the night. They used to do
Yeah.
sweep accounts, all those things. Like, I need to borrow some reserves. You have extra, JP Morgan. But then if they can't get it from any of those banks and they need more, they have to go to mom and dad. And then all the like people go, well, hell, I already lent you a bunch of money, and now you're going to mom and dad for money. Like, how bad are things on your end? And the Fed is trying to change it. But the point of this is now that New York City Bank, Community Bank Corp, their loss provisions rose tenfold. Granted, now it's a bigger bank, so they have to park more money aside for capital requirements. But it doesn't change the fact the underlying exposure they have to commercial real estate, which is in a nosedive, and landlords are having trouble. Look at rents over the last couple months. They're depreciating. So incomes for rents and office vacancy rates are at 20%. They,
Especially the office. Are you talking about
exactly offices.
multifamily? It's
Yeah,
20%?
multi-fam. Oh no, I'm sorry. Multifamily rents are down 2% year over year,
Oh,
according to
big
Redfin
deal.
data I saw last year. But you're
Yeah.
right. Office
After going up
vacancy rates
100%.
20%.
Yeah.
Yeah, you're right. No, I agree.
Yeah.
It's always the rate of change, but it going
Right.
negative now doesn't help a landlord because obviously they're fighting with more overcapacity, which we've seen a lot of multifamily home building. And now they're trying to tell people who built these office spaces, hey, convert them into condos and multifamily
Yeah.
homes. I don't know if that is not easy. Imagine an
Yeah.
office, right? There's one bathroom on a floor. You have to put a
Yeah.
bathroom, you have to redo the plumbing, you have to redo the electricity,
Yeah.
you have to redo everything. It's expensive. So what are they going to do? Take out a bridge loan like until they can start generating money? They're already underwater on the project, so they have to get a
They're
bridge
handing
loan.
over the keys.
Yeah, and that's so they're doing write-downs. And I was reading this good report by the NBER, the National Bureau of Economic Research in the US. If anyone's interested, it came out in December. Banks are already preparing for up to 10 to 20% losses on their commercial real estate books. And at minimum. The problem is a lot of these bonds, like I was saying with the regionals, after the duration risk, they can't go on the market and use these sell at this point, obviously. So they're doing synthetic securitizations, meaning they're having insurance companies, pension funds, hedge funds buy their risk. So the banks are selling the risk on their asset, kind of buying insurance, like a credit default swap from these other
Yeah.
actors. And this is the contagion I'm saying is that if one hedge fund, let's say New York City Bank now, or there was a German AT1 bonds from a that was exposed to the US. They just dropped like 30%. If there's any risk of that, any other hedge fund, any other group that insured those bonds, like just because you play hot potato with this security doesn't change the fact that the potato, it could be a ticking time bomb. You're just shifting it around who holds it. And right now I'm worried is who is on the other end of all these losses. Like we just saw with China. Evergrande couldn't get
Maybe
their.
it's the depositors that are on the hook.
It could be. There's a massive amount of uninsured deposits in the U.S. banking system. What's 45% of assets in banks are uninsured? That's flighty money, right? That means if a bank, for hypothetical for anyone, if you have $1 million in a bank and you have 250 grand is FDIC insured, if the bank fails, and let's assume they don't have many assets that they could be liquidated and dispersed between depositors to get 50 cents on the dollar, let's just say it's kaput, that's it. Individuals would only get 25% of that million, so 250 grand would be insured. So if banks are getting stressed, that 750,000, the one that's not insured, that bulk, that's flighty money. And that's going to come in and out of that bank very quickly in this era of online banking. And that's what we saw in SVB. The problem is banks, there was a good piece I was reading. It was Liz Hoffman's piece, but she basically was showing how banks had been putting this flighty money, uninsured deposits into illiquid loans, like commercial real estate. They can't call those loans in fast, right? That you'd have to find someone to buy them from you. And that's the problem, in my opinion, is if commercial real estate keeps falling, if regional banks come under pressure, they're going to be selling these assets, or hell, even just going to the Fed at a time where commercial real estate prices are falling even further. So it's like further selling on top of a glut while prices are already diving, and refinancing these and getting bridge loans is expensive. And that to me is becoming an issue.
Let me ask you this, Adam. The move we had in TLT, this should have provided some relief for their duration books, right?
Yo, I'm assuming, yeah, we will see Q4's unrealized losses. I think it'll be better because of that. Yeah.
Okay, but here we are. So the big question is with rates, is this just a correction before we do this? Or are we just
Yeah.
going to bleed down for one
No,
more
no.
low?
I
No?
think TLT is gonna go
Higher?
back to
120?
much higher. Yeah,
Okay.
yeah.
Is
I
that
mean,
your
just
best
on
idea? I mean, you usually have some
I
spec ideas, long
you
shots,
know,
at least the
I
market
do
thinks.
I
Yeah,
am actually I think it's might be time to look at China. I've been very hesitant. I mean, many shows we've talked about in the
yeah,
past, I've been very bearish China for the last
yeah,
year. Everyone said, "Oh, the reopening, it's going to be inflationary." And I'm like, "Yeah, I don't think that's going to
good.
happen." Their structure of their economy is literally not meant to be consumer driven. And now they're paying the price for it because they have no consumer economy and they're just trying to export everything, which is creating huge deflation at home. And deflation, obviously, in a leveraged economy, that's the worst situation you can have is debt deflation. It's literally the
Yeah.
worst combination. So, but now it's gotten to the point that the FXI has been beaten down so badly that, over the last, what, 5 years, I think it peaked in 2021. I think it's down 50% now. I think having that as the
There you go.
FXI. Oh, thank you. Yeah, it's been beaten down so badly that it might be worth looking at as a contrarian. Like, it's still the second largest economy in the world. Yes, they're having a demographic crisis, more deaths than births at this point. Property prices are not looking good. Consumer confidence is wrecked. Their excess manufacturing probably creating trade tensions with the rest of the world because they're trying to export all their excess abroad. Europe now is nagging at them. They're like, hey, stop over flooding us with your overcapacity. But at the same time, it could look good
Maybe
just
we
because it's so
need,
beaten down.
we're not that far away, about $20. Maybe we need this capitulation. This is a monthly chart
Yeah, I no,
because
I agree.
it was confirmed on the monthly that low. So actually, you may want to check out an interview I did with um, Bob Elliott, and
Oh
he
yeah, he's a
follows
smart
China.
guy.
Okay, and he was saying that when China was rallying this week, that you fade that intervention because their policies haven't changed. It's
Yep.
just an
No, I agree.
intervention in the market. So for
There's
you
been
to be
nothing
right,
structural.
yeah. So for you to be right, uh, and he's saying maybe they want the policy to be this way. I mean, they're not exactly for wealth creation and having people become wealthy and powerful.
No,
So,
they can't.
so
Yeah, they,
right?
the thing is in China, they are an investment driven economy. It's not like the US. Like in the US, we have, for example, social safety nets. We have juiced up household wealth.
Yeah.
We have a very low savings rate, mainly because we run a huge fiscal deficit when the government is trying to offset the weaker demand. They run this huge, like in Japan situation, they run a massive fiscal deficit to try to keep money in their consumer spending. In Japan, they just aren't doing it. China, same thing. For GDP is always out of 100, right? You got consumption, investment, government, exports, or imports, exports. If one goes up, somewhere else has to go down, right? It's you can't have them all go up at the same time. It's always a trade-off. So in the US, if you juice up the consumer class, which makes up 70% of our GDP with cash, it'll fuel consumption. We have very lax debt, etc. In China, it's 50-ish% consumption. It's extreme. I don't even think it's in the top 20 countries in the world consumption-wise of GDP, and yet it's the second largest economy. So the way they were able to mask this for so long was through infrastructure spending and debt, and it caught up to them. Their macro leverage to GDP, like collective debt, not even including local governments, by the way, is around 300% of GDP. When that ratio grows, right, debt to GDP, that means the debt is growing faster than productivity. So in China, all they hit diminishing returns. For them now to rebalance, they would essentially have to switch their economy, take away from their investment share of GDP, take away from their net export share of GDP, and boost the consumption side. And I think Bob Elliott's right because they don't want to do that because to do that's politically extremely difficult to do. Japan couldn't even do it after they blew up in 91. It couldn't
Yeah.
even get through the Liberal Party, their
Well,
Liberal Party, the
let me ask you
Democrats.
this, and this would be something probably cataclysmic, but here's the FXI and where a third drive line comes in, uh, $10. Could they cut them in half again? And then
I,
that's really, that's pretty
I mean,
extreme, isn't it?
anything's possible. Who knows what'll
I'd try it
happen.
down there.
Oh
Anyway,
yeah, like, it
all right. Anyway, so you're
it's
looking at
hard to
maybe
say.
buying some calls. Baba doesn't look much better. Um,
No.
Baba, uh, this looks, like where could it go here? 23 from 70.
Yeah. No, I mean there's definitely potential
I mean, it's just a
downside.
line. It probably doesn't mean anything. But write those
No, I
numbers
mean
down.
I agree. I mean, but like also who knows? But I do think possibly going long call China. I'm sorry,
Yeah.
calls on China here. Even though I'm bearish China, like I don't like it, but just from a risk reward perspective, it's worth like the flyer at this
Okay.
point.
Got it.
It's
Anything
better than
else?
buying calls in the US. Yeah, I'm cautious about the US this year. I think loan demand is drying up, and without demand, wages have been weak. I think since 2020, real wages have only risen, what, 1.2% over the last 4 years. Like it's not enough to carry growth, and I think that's going to be a problem this year.
Isn't
I mean,
is
temporarily.
with your view on semiconductor supply? Wouldn't
Oh,
this be also
yeah,
one of the
no.
most contrarian trades to buy puts on semis when we're worried about China? With the way things are going in China economically, do you think that makes it more likely sooner rather than later they make a move on Taiwan?
I think if if they make a move in Taiwan, I'm assuming TSMC is going to be rigged to blow. Like, there's no way they're going to hand that over to China. And I don't think China, what would be the point then? Because they depend on those the fabs in I'm
Right,
sorry, in Taiwan. Like everywhere
right,
does. I mean, US is now trying to build some here, but that'll take what,
right.
3 more years. So
Yeah.
I think until China gets their own infrastructure, their own technology to at least get somewhere to the three fab minimum, 2 to 3, which obviously that's TMC is like the biggest one. Then I
Okay.
think they might make a move. But I think if they did it, it would be shooting themselves in the foot. But who knows? You're right. I mean, like politics always trump. I mean, bad
Yeah.
politics always trumps good economics. So
Well,
these people can
that's
do
always the dictator's playbook. When the
exactly.
economy gets bad, and the population is not happy, is to unite them through a military adventure.
Yeah, find some
Uh,
scapegoat and
yeah.
try
Well,
to
you know
rain
what?
hell.
You were worth the wait.
No, I'm sorry about
Oh,
Wednesday.
stop
How
saying you're
it
sorry
was.
already, you
I
millennial.
mean, I know, but I do hate when I say I'll be
Uh,
somewhere and I don't be there.
all right. Well, it's the first time you're human. And you've been talking for years. It led for you to do something on Trader Summit. You're part of the family, man.
Well, I appreciate it, and it's always a pleasure to speak with you, Dale.
People should follow your writings. I hear you're writing for other people, but most of your writing's still showing up on your website.
Yeah, the good stuff putting
Okay, the good
on my
stuff.
site.
And
Yeah.
it's what, Radical Adem? That's not the name of the website, is it?
No, it's just Speculators Anonymous, but my Twitter is Radical Adam, Adam with an
Yeah,
E. And then if
yeah.
anyone's
Okay,
interested, I just post stuff a lot on China. Like China's deflation rate last night came out, just lowest deflation in 15 years. So there is no, I don't see any economic activity there. GDP deflator's been negative for 3 quarters straight. So God knows
okay.
how that's going to end up.
Well, if you're still in La Jolla in the summer, I'm in the high desert. Fix up a cot for me this summer. All right.
Yeah, right. There's some good
We'll
deep
get
sea
together.
fishing.
All right, man. So
Sounds good, sir.
here you go. Pretty interesting take from a Dem. But with what you see with regionals, you think it's too obvious to buy puts there with what's going on?
Yeah, I think it might be obvious now, but I think there are a couple. Like I'm looking at Bank of Ozarks. They're very
Yeah,
leveraged to commercial real estate.
yeah,
I am worried about the auto lending market. Auto loans have just not been a good investment. Negative equity
yeah,
now is what, 6,000 plus a car. Subprime defaults around 7%. It's
yeah,
it's looking shaky, and it always worries me who's on the other side of those loans and how far that can spread. Like we don't know. Like look at German banks today, Japan banks. A lot of them have been racked just because of U.S. commercial real estate woes. And I think you're going to see more loan loss provisions uh, being put into these banks. But who knows? Maybe the Fed will bail them out again, and it could all be meaningless, and then they rally hard, right?
yeah.
There's always
That
something
put
that
in
can
the
happen.
stock bottom. The SVB was the March low, and it's been a
Yeah,
rocket ship ever since. So
it's very
bad
true.
news. Bank failures are very bullish equities. That's a
Exactly.
new
So
paradigm,
So
right?
exactly. So who knows? Like,
Yeah,
it could be the best thesis for fundamentals, and then
yeah,
government comes in and says, we're bailing it out, and then everything goes out
yeah,
the door.
yeah. Been there. So, Adem, thanks, buddy. Good get back hearing what you're thinking. Always
Yeah,
enjoy it, find it very interesting. I hope you have a great 2024, my trading warrior brother.
you too, sir, and hope to speak again soon.
All right. Adem, everyone follow him on X at Radical Adem with an E. And that's a wrap, everyone. Hope you had a good week. I'm exhausted. We laid it on the court for you. And Don't just count your pips, count your blessings. See everyone next week. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.